Hi everybody, welcome to today's Facebook Live. I am Tina Powell and this broadcast is coming to you from Beacon Wealth Management in Hackensack, New Jersey. And we're really excited for today's broadcast on tax reform. It's the bill, it's the topic that everyone is talking about. And I'm joined by Mark Germain, CEO of Beacon Wealth Management. And he's going to tell us exactly what we need to know and explain the tax bill to us. So before we do, a few housekeeping issues. Today is Thursday, December 21st, 2017, and the time is 3 p.m. Eastern Standard Time. This Facebook Live is being recorded. Please remember that this broadcast is giving an opinion and not blanket advice. Any performance numbers are historic, and you must put your own personal situation into perspective and speak to an investment professional, ideally somebody that knows and understands your own goals and objectives. So today I am going to interview Mark Germain, the CEO and founder of Beacon Wealth Management, and Mark is going to talk to us about the 1.5 trillion tax bill, also known as the Tax Cut and Jobs Act. That's TCJA, another acronym that we have to add to the vocabulary.
Right.
So the final bill is awaiting the president's signature, and it moved through Congress at a breakneck pace. Do you think, first question for you, Mark, is that do you think that this move was strategic in nature? We've never seen a bill of this magnitude move quite so fast and get congressional approval. So what are your thoughts?
Well, number one, I think it's important to say that the questions are going to continue to come. We actually had to break away from client calls so we could do this call, but I think it was very strategic. It certainly wasn't tactical, because if we put things in strategic and tactical, this was the president's strategic initiative right from the very beginning to get this off the ground. And most people are not really in favor of this tax bill. As a matter of fact, if you look at yesterday, the market went down. Everybody was saying they were not in favor of it, or I wouldn't say everybody, but a very large percentage of the population. There's plenty of protesters interrupting the Congress, and the rates take effect January 1st, which is literally 9 days away. According to the Nonpartisan Tax Policy Center, this could actually mean that once Americans start to see an actual reduction in their tax bill, they may change their mind, but they may actually start to say, oh, this wasn't such a bad idea. I will tell you that people in the states like I'm in New Jersey and New York, Massachusetts, California, the SALT states, probably won't be. But supposedly 80% of taxpayers will see a tax cut in 2018. I say supposedly, let's see what happens. 4.8% are going to see a tax increase. I'll raise my hand on that one because I probably will see a tax increase.
So I know one of the groups that will receive a big break in tax is corporations. And actually the corporate tax right now is presently at 35%. But now this bill that's introduced into legislation promises 21%, going from 35 to 21. In hopes of encouraging corporations to hire new people and to raise wages. A question for you, and something that we've also heard, is that a lot of corporations have cash on the balance sheet right now. So what's different with this bill? Are they actually going to hire, increase wages, and are we going to see a significant difference in the way that corporations are behaving right now?
There's a couple of variables in there. One, they do have cash on their balance sheet. Cash on the balance sheet doesn't mean that it's available for pay raises or that it's available for expansion of the business. You have to look at your working capital and what's going to be happening going forward. Also, let's get back to strategic. Very strategic that what they're trying to do is to get the tax rate in line with foreign entities and with other countries. So number one, if you make the U.S. the lowest tax country around, very strategic that American companies are not looking to move their operations out of here because they're going to be able to make the money here. So permanent reduction to the tax rate. This is not temporary. Remember, in the tax bill, the parts that affect us as individual taxpayers go away in 7 years. So it's all up for grabs in the next 7 years as well. Losing jobs due to inversions where corporations are going away. So people are basically, the companies are going overseas. And it's because of taxes. Canada was 26.5. Now we're lower. Ireland's currently at 12.5. But there also is a repatriation of all of that cash that's sitting on balance sheets in other countries that can come back to the U.S. at lower than the tax rate that is in the respective countries where it's sitting. So 2.5 trillion in unremitted foreign earnings. That's the money that's going to come back in. As we lower the tax rates for corporations, what happens? Profit goes up, which means when we look at the stock market, most corporations are rated on a price to earnings multiple. If the price to earnings multiple remains the same, let's do a very simple example. You make $1 and the price to earnings multiple is 10, your stock sells for 10. If all of a sudden, because of the tax deduction, you make $1.50, your stock should go to 15. So tax on par with the rest of the world, make America much more competitive globally, allow American companies to create the new jobs here with the tax savings versus looking outside, counting on corporations to hire and to raise wages. I would say the number one thing is wages, yes, but let's start investing back in America and get to the next strategic initiative, which is infrastructure. Studies support that getting the reinvestment back in the economy. So on September 29th, 2017, National Association of Manufacturers survey for the third quarter indicated that the tax reform would have a positive effect. Specifically, and I marked this number down, 64.3% of those surveyed would expand their business. There's already small expansion starting. 57.3% would hire more workers, and 52% would increase the wages and the benefits. As a matter of fact, a number of companies, FedEx one, already paying out bonuses this year that they weren't planning.
Interesting.
Yeah.
So just a little bit of a follow-up question. What do you see for the market next year? Do you think a move of this proportion with the tax reform and what you just talked about, the rising PE ratios of American corporations?
Not even rising, yeah.
Right. Do you think that this is going to have a positive value on the market as well? I mean, it's been performing really well in 2017.
I think that there's two things to always look at. One is the fundamentals of the business itself. So you can't do away with the fundamentals. Just because someone pays less tax doesn't mean that their business is better. So one, the fundamentals are here. The fundamentals are strong. This is the most disrespected and the most disliked expansion that we've had ever in the history of the United States. People didn't believe it, didn't think that it was going to continue. It is, because the fundamentals are there. And if the fundamentals continue and corporations make more money, stock prices go up. Do I think we'll be as good as this year, next year? Probably not. We don't think it's going to be quite the same, but it's still going to be positive for the market through the first part of 2018.
Can you talk a little bit about private business? And there's a lot of talk about pass-through businesses receiving a 20% deduction. Number one, can you explain what a pass-through entity is? And number two, why wouldn't this apply to all types of businesses? Why is it just a pass-through entity that would be receiving this benefit?
Well, that's a good question. And corporations and most of the businesses that you see that are open on the stock market are corporations. And a corporation is structured that they first pay tax. Then, if they pay out a dividend to you, you get taxed on that dividend. A pass-through entity, real estate, an LLC, an S corporation, all pass the profit through without first taking a tax bite off. So that profit passes through to the owners. So as an owner of an LLC and as an owner of your sub-S corporation, then you would think that that money is going to now pass through and be at the 20% rate or have the 20% discount. Oh, little trick, okay? Doctors, lawyers, accountants, financial advisors don't get the pass-through credit unless their business grosses less than either 160 or 320, depending on where you are in a marital status. So the pass-through entity says the profit is passing through. If it's a manufacturing firm, if it's a limo company, if it's something that is not dependent on the person who runs that company. In other words, if everything isn't tied just to that person, a la a doctor's office is tied to how well the doctor is as a doctor. That means someone can't just step in and run that company the same way. And those don't get the tax breaks.
Well, I'm glad. I think this brings me to my next question, and I'm glad that you've already helped to pave the way. What does this mean for Beacon clients? Some of your clients are doctors, lawyers, accountants, and some of them are just entrepreneurs. So can you give us a little bit of guidance?
Well, actually we can. So when we look at what has been the number one thing that we've been doing for the last few days is figuring out how many deductions we can actually legally take in 2017 without pushing people that are within the alternative minimum tax range into that territory. Two, how are we going to do things going forward? In particular, doctors set up as corporations, other holding companies, and a lot of doctors' offices and medical practices can't have non-doctors owning that entity. So there are a number of limitations. So we are, as with all of the CPAs who deal with our doctor clients, are going to be scrambling to figure out exactly how do we keep people out of the 4.8% of the market that's going to have an increase in taxes. So there is the expectation that there's going to be paychecks and take-home pay are going to be going up. They said the typical family would get $2,059 in tax savings. Strategically, what's the objective? Get it into the market. So as we look at the tax rates and one of the things that's happened is we've gone from the highest tax rate, which many of our clients are in, 39.6, down to 37. And they've doubled the standard deduction. So what is this going to do for some lower income, middle income people that just are at the margin on their itemized deductions? They may be able to file a simpler return and actually save some accounting fees.
And that return, you're talking about the return that would actually be filed in 2019 for 2018
right. That's correct.
Tax year, right?
That's right.
Okay, good.
Now, they increased the standard deduction. They actually doubled it, but they took away exemptions. So if you had 5 kids, you've lost the benefit of those exemptions. You now have just the standard deduction. And they're going to be limiting the amount that you can take off on your itemized deductions. The very first thing is home mortgage interest and then the SALT. So I would like to be in a SALT-free state, meaning no state income tax. However, in New Jersey, one of the highest in the country, we are not going to be able to get a full deduction for our state income tax. Maxing it out between your property tax and your state income tax at $10,000. So for those of us who might be paying more than that, those people who live in the county where we are right now, Bergen County, very few of them only pay $10,000 in property tax and or state income tax. So that's going to be a real problem.
So another one of my final questions here is, so what specifically, there's only 10 days left. There's only 10 days left of the new year. So what specific strategies are you recommending for Beacon clients with those 10 days left? You just mentioned property tax. Would you advise a client, especially living in New York, New Jersey, Massachusetts, or California, to actually pay more this year in 2017? What are some other strategies? What can people do now?
We're recommending to clients in every one of the states that we're in that A, pay all of your 2017 property tax. B, you can pay 2018 property tax, as long as it doesn't force you into AMT territory, alternative minimum tax territory. The good news is they have raised the limit on alternative minimum tax. Properly structured, we did this for a client yesterday where we huddled with the CPA and said, we don't think it'll throw him into alternative minimum tax territory if we pay his 2018 tax on one of his houses. So the important thing is you can pay 2018 tax, you cannot pay 2018 income tax, but you can pay all that you think you might owe for 2017. You can pay it now before the end of the year. Don't send it in as a deposit when you extend, or don't pay it in January 15th. Pay it on December 30th and get it out and paid in 2017, and you will get the deduction this year.
Okay, so it sounds kind of complicated. What if any of our listeners out there have any follow-up questions regarding whether or not it's tax planning or wealth planning or investments? Who should they call? How should they?
Always, they can go to our website and they can send us a question right on the website. We're happy to get to it. I will tell you that if it's detail and you don't provide us all of the detail, we can't give you an accurate answer. I think it's really important that, in order to give an accurate answer on taxes, we have to see what 2016, were you in alternative minimum tax, in 16, if you were, chances are you're going to be in 17 as well. So you have to look at the numbers behind making a decision. Should I pay my taxes? I don't know, because it depends on your income, depends on how much your tax bill is, and it depends on what other income you had this year. This was a particularly good year for investors. If you had a lot of capital gain and it's raising up your taxes, you may all of a sudden find yourself in alternative minimum tax territory.
Okay, great. That was a lot to digest in a short period of time. I want to thank you for making yourself available. I know it's very busy, and this was a great segment today.
Yeah, we are having, and you'll probably get to this announcement one of these days, but we are starting to have kind of roundtable discussions in our office on the tax bill in the beginning of 2018, long before people have to start making decisions, and give them the opportunity to make planning decisions well in advance. Okay. And the first one is January 23rd.
Okay, great. And I will also tell you that these workshops, these tax workshops that you're talking about, if you follow us on Facebook, you'll be able to see them on the events portion of our Facebook business page. And of course, you're welcome to send us a message through Facebook Messenger, and you can contact me at tina@bwmllc.com, and I would be happy to put you in touch with the people who you should be speaking to. So thanks so much. Thanks everybody for watching. We hope that you have a happy holiday and a healthy new year. Thanks.
Thank you.